This channel is for educational purposes only. Please do your own due diligence before making any investment decisions.
Hi, this is Joe Rabil. So I want to go back to the basics here, and it might seem like the basics, but if you go through and I'm going to go through and show you a few keys to entry, all right, that you probably aren't aware of. I'm going to give you triggers 2 and triggers 3 and explain how they're different and how they can be identified without the use of MACD or ADX. All right, we have to start with the price action with the moving averages as our keys, right? And then we use the supplemental information from the MACD and the ADX to give us more detail. All of this is outlined in my course and in my courses, but I wanted to make sure I covered this because I think it's a key detail that we need to know. Now, if you want to learn more about the techniques, I would suggest starting with the book. It gives a good outline as to what you're trying to learn, and then we go into a lot more detail when I go into the course. All right. Now, also, if you do enjoy this content, please hit that like button and also subscribe. Okay, I've got the chart of Cummins Inc. CMI up, and then 4 charts, and they're laid out perfectly because we had a setup on the monthly chart and a trigger on the weekly chart, and then we had a setup on the daily chart and a trigger on the hourly. All right, so it worked out perfect. I'm going to use all 4 of these time frames. Now, I do want to point something out. I got a request to use just 2 charts. All right, and if I'm just talking about 2 charts, that's fine. But you have to get used to looking at charts this way. All right. I mean, if you're going to follow, I think any kind of approach, I mean, in most cases, I think you're going to need more than 2 time frames. You want that upper time frame or that lower time frame to add a little element of timing and or so a lot of times, let's say I'm using the weekly chart with the daily. Well, I want to know what's going on the monthly, especially from a support and resistance standpoint. It's going to really help with the target levels that I can derive on my trade off the daily. Okay, and if I'm using the, let's say I'm using the weekly and the daily, and I'm looking for an improved timing, then I can go to the hourly. All right, I can refine my entry using the lower time frame. So I would get very, very used to looking at this way. We start with the big time frame, and then we work our way down to the weekly, then we go to the daily, then we go to the hourly. Get used to it. Look at thousands and thousands and thousands of charts this way. Okay, your subconscious mind is going to take over, and you're going to start to see these things. But you need to look at lots and lots of charts. It just can't be done any other way. Now, I'm going to show you, let's just start with the monthly chart. So the monthly breaks out of this base here. It gets things moving to the upside, and then we get a pullback. Now, in this pullback, we have a rising moving averages. We have 18 above the 40, both lines rising at about the same rate. This is exactly what we're looking for. If we're looking for a pullback, this is what we want. Now, this time frame in this pattern, if I'm going to buy it, if it's a weekly, daily, this time frame is the most important time frame. Okay, that is the time frame that I'm trying to get in and play a move in. All right, I'm playing the monthly because it's got the rising moving averages. It's got the setup. This is the setup. Pullback to support. I mean, it really has a lot of little things going on here. If I did the fib retracement from here to here, you know, we're in that zone somewhere around the 50% level, and we pull back to this breakout area. I mean, that's a beautiful setup with a reversal bar. All right, we get the big bottoming tail. All right, and then we get what I'd be calling is follow through to the upside using the weekly chart. All right, now if we go to the weekly, we have what I'd call an ABC decline, ABC corrective pattern. All right, and that's where we're getting into this area here, and then it rallies up into the zone between the 18 and the 40. Okay, now notice one thing here, it's kind of key in this setup, is the 40 stays rising. Do you see how that's not rolling over? You see how it's rising throughout the whole pattern? That's really important, okay? If that's rising, then you're not turning the trend bearish. You're only turning it neutral when the 18 crosses down below the 40. Now, if both lines are rising, price is below, then we have a negative trend. It's probably going to take a little bit longer to reverse things. But as long as this 40 is rising, we can get the quicker reversal. Now, look at the way it played out. It went in the zone. Let me get rid of this. It went in the zone here on this bar, and then the next bar it came out of the zone. And then it kind of walked along the 18. Now, one of the patterns out of my book is this parallel lines pattern, and I use the MACD with it. If MACD is above the signal line, but you can look at it by itself. If it's just walking along the 18, that's not really breaking away to the downside. That's pretty bullish. And then we get a bullish kind of outside reversal bar. We get across to the 40, lots of good signs there. But what I could do in this instance is kind of go up to one more time frame and see what's really going on here. And I can see that what's happening is the 18 and the 40 are coming together, but it's not crossing. And we do have an ABC decline. We drop down, right? And then we made a rally up, and then we made a lower low. All right. So I can draw a trend line there. I can draw a trend line. I don't need to look at MACD or ADX to do that. I can draw a trend line because I've got an ABC decline. All right, now that's happening. That cross is happening right around the time the two moving averages are coming together. And so I'm looking at that and saying, that's actually a pretty good entry there in that setup when I'm looking at it in relation to what's going on here and what's going on here. So I can do this and see that this is a trigger 2. A trigger 2 is when we go in the zone and then we come out of the zone. And then the question becomes, do we take out this low? All right, do we come down and make trade really poorly and come and make a lower low? If we do that, then it's a sell signal. It's a purebred sell signal, right? But in this case, we didn't do that. We just had one bar down, and then, actually, that's not true. We had, one bar down, and then an inside bar, inside bar, inside bar, inside bar, and then we ticked out that low by a minor amount in the reversal. Do you see how all these bars are inside of this one bar? So that to me is kind of important. That's not really progressing lower. Just so you understand, if that happens, there's very little likelihood that the ADX is going to be strong to the downside. It just can't be because you're not making progressive lower low action. Okay, so you got to know how that's calculated to understand that there's no way the ADX is going to be strong to the downside here. All right, now as we progress through this, again, it makes the move to the upside, crosses above the 40. You could have used the lower time frame to get in a little bit earlier, but that is a pure trigger 2 there, where we go in the zone. And then we just come right back out, and it doesn't go to a new low. And once that happens, we're looking for the first sign. If we got a big green bar here below the 40, I would say that's a trigger. But we got kind of like a good bar, and then we closed above the 40. I would have probably taken out this prior high. And again, if I'm watching it on the smaller time frame, I probably could get I'd probably get in a day early or something like that. All right, now that's trigger 2. Let's show you trigger 3. So we make a move, we're continuing to move higher, and then we get the pullback here. Strong move with a gap up, and then we get a pullback. And look at what this is and compare that to this. Look at the rising moving averages, right? And we pull back to those moving averages. We're pulling into those moving averages. Now, I want to go down to the hourly chart and time this one now. But this one's a little bit different. This doesn't stop. Well, it stops for a few days at the 40, but then it busts through with a big bar to the upside. Now, I know a lot of people would say, well, because it wasn't straight up through, so it's not a trigger 3. But I would consider it a trigger 3, and the reason is that if I'm entering on the close above the 40. Okay, my stop is going to be above the 18. 2 times the ATR, it's going to be above. It's probably going to be something like that. And that means that I don't really want to put a stop above the 18. It makes no sense to me. All right, I'm not going to do that. If the stop goes down here, then I guess it would qualify. But I would kind of consider this big, strong move off the low. And then kind of where you're going to place your stop on the cross of the 40. Well, I don't really like this stop. All right, it's above the 40. It doesn't make any sense. So I'm going to let this play out, and then I'm going to buy the first pullback. Well, we get that first pullback, and it's really in the same area as where you would have been considering it before. But this time, we have a really big bottoming tail and then a reversal. And this move to the upside here, as it's taking out this high, would have been used, this big green bar, maybe using the midpoint of this big red bar, maybe entering somewhere in that area. But either way, I think you've got a better setup here on a trigger 3. A trigger 3 is where it goes straight through, and then we're waiting to buy the first pullback. All right. Now, in this situation, ideally, we'd want it to hold the 18, right? But it didn't do that, right? It didn't hold the 18 in this situation because it had that big red bar to the downside. All right. So when that happens, we've got to, we've got to kind of continue to watch and see. If you notice, that big red bar did not have big volume. I mean, that was just down. The big red bar was at the peak here. The next bar was a down bar without a lot of volume. So I kind of minimize the importance of that a little bit when it doesn't have a big volume associated with it. It should be at least greater than normal. So that kind of, it tells me that it was down in association with its group or the market, right? It was guilt by association is what I call it. It's not really down because of its own merit. It's down because some other stock in the group or something like that is getting hit. All right. But in the same time, it went through the 18. So I can't use that. I like it when you get a move up and then we pull back to the 18 and we hold. But I see this often. You get kind of a sloppy pullback, all right? And then as it emerges above this little consolidation area, then we can enter off that. Now, again, I'm not going to go down, but you could go down to the 10-minute chart, and I guarantee you'd see a little breakout area that would look, pretty well defined. And then you could make that determination of whether you want to wait for the midpoint of that bar. Now, because of the way this played out, and you got this big, strong bar here, if the ATR were something like that. Now, one of the things I do want to point out, with these big bars, especially at lows like this is a big bar. Remember, I know I use the big bar as a big green bar, but big bars can be bottoming tails just like this. The midpoint of this bar is really important. So if the stop, using our approach, if the stop is just, near that midpoint or below, then I'm fine with that. I'm totally fine. It doesn't have to be below the low of this bar. It just has to be, I like it to be below the midpoint of that bar. But just keep in mind, we had another big green bar right after. So if your stop was slightly above, it's still going to be okay in this situation. All right. And then we get the follow through on this trade. So, when I look at this, I kind of say we've got trigger 2, right, and trigger 3. We need to know them. Now, obviously, the MACD and the ADX could help us with the timing somewhat in these. I'm not trying to tell you not to look at those, but you want to learn these separate. Learn these triggers. There's 4 different triggers out of my course. Know the triggers first using the price and the moving averages in relation to the price bars, these big bars, all that. You got to use all of that information, right? Bottoming tail here, and then add in the MACD and ADX. Don't do that. Don't start looking at the MACD and the ADX first. All right. Let me know if you have any questions. See you next time.